Welcome everybody, it's Mike Smith from Hawkeye Options here, and you'll notice we've got the SPY up, the ETF that tracks the S&P 500. A couple of reasons for this. First of all, I thought it'd be useful to talk about where it is at the moment, but secondly, obviously, a potential trade for today. Now, of course, you've got non-farm payroll, so this is likely to move markets significantly. But just before we get to that, we'll notice a couple of things that are fairly obvious. First of all, this support we've got at 217. Note these pivot lows here and here and pivot highs from early July before we broke into this next range between 217 and 220. Obviously a very tight range, less than 1.5% from top to bottom. And hence, even though we've tested going below that 3 times really in the last week, we've managed to hold our way over that by the close of trading. So it doesn't look as though the market wants to sell off, but neither does it look as though it's that convinced we should go higher. However, of course, non-farm payrolls are a deal breaker. Whether the market will respond positively to a strong number or not, and hence the greater likelihood of the Fed to consider raising interest rates this year, or whether the market response is going to be more positive on a Goldilocks number, so not too hot, not too cold, is a little difficult to tell. But really, we should be switching new bought call trades off in light of the fact that we're in congestion on the S&P 500, and particularly if we break down below 217. If we look at the time frames on the 2-day and weekly respectively, we see selling volume on the 2-day, and we see buying volume on the weekly. Now, if it's another poor night in terms of either a move down or really remaining in this range that we're in at the moment of about 1.5%, then expect that not to be a green buy-in volume bar that we see there for the end of the week. Those of you who are trading with Hawkeye Live will be able to see that after market open tonight. So really, possibly the best way to play this is to look at a range-bound trade or a potential credit spread. Now, if the market response to non-farm payroll is positive, we could see this back up to 220 pretty quickly. So a 215, 220, 225 butterfly trade may well be positive in terms of a way to play this type of market. If, however, we see a break below that 217, because of the uptrend that's still in place on the 2-day and the weekly chart, we couldn't short that particular position, but we may well look to put a bear call spread, so a credit spread above this 220 level, which is obviously relates to those 2 pivot highs that we saw a couple of weeks ago, being the last one, and put it at 220, 222 or 225. With expiry less than 2 weeks, just to try and scalp some money off this very difficult market to trade. So that's what we're looking at today. Obviously, we'll make our decision once we see the initial market response to non-farm payrolls, and of course we'll get that in that hour gap between the number being released and market open. So we'll see you again soon, and have a great weekend.